What time frame to use when day trading is an important choice. And the right time frames will vary by each person, the strategy they use and how they like to spend their trading times, meaning more related trading sessions versus more intense ones. In this video, we will talk about a simple concept of the choose the right time frame for the day trading in our order to make the right decisions right from the beginning. Professional traders spend little time choosing the time frame. The choice of the time frame isn't based on their trading strategy of the market in which they are trading. It's based on their own trading personality. Before we begin, here's the chart that shows the difference between 1, 5 and 50 minutes chart. They all show 20 hours of the price data and the same day, but as you notice that there are significant differences in the details. So let's talk about the benefits of the drawbacks of each day trading time frame, so you can decide which one is right for you. 1 minute time frame may work well, or someone who likes seeing detailed in the price movements and potentially getting in and out of the short-term traders that only lasts a few minutes. Trading the 1 minute requires nearly constant attention, while trading since candles are generated every minute and trade signals can occur, often depending on your strategy of the course. Because price bars occurs frequently, 1 minute chart trades typically have the opportunity to take more trades per day compared to the other time frames. With winning systems, more trades means more profit and faster compounding of the occurred, but with the potential of the more activity, a trader who doesn't have a good risk management strategy can dismiss their capital rapidly. On 1 minute time frames, it's possible to make several trades within 2 hour trading sessions, and it's perfect if you don't want to spend too many hours in front of your screen. With trades based on the profit targets tend to be smaller than those used by the higher time frames traders. This doesn't have to be the case though. Traders could use small stop losses on the 1 minute chart and aim to large reward risk trade. The main takeaway is that the 1 minute time frame is for people who want to maximize their trading time, and more traders typically with slightly increased position size using the small stop losses and the profit targets. A 5 minute chart may work well for someone who focus on a bigger intraday trend and doesn't need to see it in the opening high to low close price every minute, but would rather get data over a 5 minute period. Trading a 5 minute requires focus, but let's constant attention that 1 minute chart because candles are forming every 5 minutes, so there is more time between data points. If you wait for the candles to close before actions, this means no actions is taken for at least 5 minutes intervals, and often longer. Those 5 minutes charts targets tend to trade less than 1 minute chart targets because there are fewer candles to act on. Depending on your strategy, one or two traders may develop in the 2 hour trading sessions positions more but less than 1 minute time frames. Stop losses and the profits targets tend to be larger than the 1 minute chart. This isn't good or bad, but it does typically mean fewer targets per day because candles and price slides are bigger on the 5 minute chart, This means a greater distance between the chosen entry and exit. So the main takeaway is that the 5-minute chart is for people who want to focus on a large intraday movements, receive fewer signals with moderate position size. 50 minutes time frame is for someone who wants to see the major trends and the movements throughout the trading day. It's a trading on 50 minutes chart requires less contrast focus because candles are occurring over a longer period. If you wait for the candles to close, then there is at least 15 minutes period between the position actions. Traders on this time frame may only be talking 1 or 2 traders per day, but if you are only trading during the 2 hour sessions, many days many have no trader signals. So trading these time frames may require more time in front of the screen since it takes longer to get into and out of trades. Stop losses and the profit takes tend to be larger than the 5-minute charts, so this means fewer trades per day. Position size are usually smaller than those on a 5-minute chart because candles and price swings are bigger, which likely means a greater stop loss distance, but because of the fewer trades and the smaller position size, it is easier to have multiple positions. The main takeaway is that the 50 minutes chart is for people who want to focus on the large price movements throughout the day. If you don't mind waiting longer or for traders to open and close, if you prefer to clean movement, and if you plan only 1 or 2 trades over multiple hours of trading, then the 50 minutes time frames might work for you. Some traders only day trade on the time frames, while other trades multiple time frames to produce trading opportunities. A single time frames means you see the trade on the 1-minute chart or whatever time frames you see, and you take the trade. Multiple time frames trending means you look at a longer term chart and use it as a filter for trades on the lower time frames. In this case, a trader may check the 50 minutes for overall trend directions and then look for the opportunities to enter the trend directions on the 1-minute chart, for example. Most day traders pick the time frames and then almost never leave it. They are also locked into their time frames and they forget about the bigger picture. The other example are traders that constantly jump from time frame to time frames without much of the plan. That's why the best solution for the top-down multiple time frames analysis, where you start on the higher time frames, the 50 minutes or the 30 minutes time frames, look for the bigger pictures, perspective, and then slowly build your trading plan by going lower. And don't start your analysis on the work lowest time frames and then work your way up to the higher time frames. This creates a very narrow and one-dimensional view, and it missed the point of the multiple time frames analysis. Now, time frames are often discussed as if they are the only charting of options. They are not. They are chart types based on things other than the time, and of them it's the range bar chart. Range bar are the bars that are plotted on the chart that have the same price increments, the same height, and each bar close easier at the high of the low regardless of the opening price. There is no time component as you would see with candlestick charts or the bar charts. In trading, for example, if you want to range of 10 pips on the pound dollars and you are trading with range bars, set your range to 100. Every time the pair moves 10 pips ups or down in total for the bar, it will complete the current bar and stand a new one. So time has no effect. Here are the key takeaway to keep in mind when day trading with range bars. All range bars are uniform in size because the range is constant. You can choose any bar size you want based on your needs. You can select a 4 pip, a 39 pip, or any size you want. The time period covered by each bar is irrelevant as the range bars are time increments. For these reasons, range bars can help you to identify the ranging price actions in a blink of the eye, and potential support and resistance levels are more clearly visible on the chart. Probably the biggest advantage, especially for the day trading and the scalping, is that what of the false signals that come with the time-based charts are eliminated. Time-based charts will always post the same number of the bars during each trading session, regardless of the volume, volatility, or any each other factors. The only time you will see more range bars printed on the chart is when we have periods of higher volatility, and even then it depends on the range bar size selected by the traders. Inversely, when we have the low volatility, you will see fewer range bars printed on the chart, and this is the huge improvement over the classic timeframes. So if you ever struggled with range management strategies when day trading, try using range bars, because range bars are the effective tool to time your entry and exit points. Another day trading and scalping alternative is the tick chart. The bars on the tick chart are created based on the particular number of the transactions. Again, time is the irrelevant. For example, a 200 ticks chart creates the new bar after every 200 transactions. You can customize ticks charts to the number of the transactions you want. For example, 5 ticks or 500 ticks. Remember, time does not play a role here, as the tick charts are transactions based and new bars are formed only when these are enough trades to make noise is reduced. And you know that higher the noise, the more difficult it becomes to make the smart decisions, especially when the day trading, when you need to react fast. The main advantage of the tick charts is that compressed low activity trading period. On the time-based chart, you may see 20-30 useless candles, while the tick chart may offer you only 10-15 relevant ones. Tick charts can help you in placing better stop loss orders and take profit levels on the chart. This is especially useful during periods of high volatility and rapid price movements, and without accumulations of the small candles like the ones of the time-based chart. This chart make it easier for the trade to stop price swings. I will say it once again, there is no best time frame or the combinations of the time frames. A winning strategy can be built in any time frames or any combination of the time frames, but understanding the pros and the cons of the each time frames will hopefully help you to decide which one works best for you. I'm mainly a swing trader, but when I day trade, I tend to use multiple time frames analysis using a range bar. This works for me, but might not be your style. One time frames is not better than the other, but one may be more favorable to you because it provides more trading opportunities or has a clear look. And it's your job to backtest, analyze the data, and which one works best for you. As always, if you learn something new and found value, leave us a like, share, support, and don't forget to subscribe and hit the bell icon to be notified every time we release a new video. Until next time.